Welcome back to Hot Topics, live from the Fabre Framework Studio. Today's episode is all gas and no brakes. We're tearing into money talks, home buying truths for today's market. Because in this real estate climate, financing isn't just a detail, it's a deal maker or deal breaker. I'm your host, Quan Rimmer, and first on the mic is
I'm Nathaniel Bittman. I'm with Hancock Whitney Bank.
Nathaniel Bittman is the vice president of mortgage production at Hancock Whitney Bank. With nearly 3 decades of mortgage mastery under his belt, this man has seen every market shift, every rate hike, every lending trend, and come out ahead. A former president of both the Tampa and Florida Mortgage Bankers Associations, Nathaniel is a strategist who can take a complicated financial puzzle and turn it into a smooth, stress-free closing. His reputation is solid gold in the lending world.
And in the blue corner.
And in the blue corner.
That's funny.
You're hired.
Yeah.
And
I'm Sean Miller with Van Dyke Mortgage.
Sean is the branch manager of the Sean K. Miller team at Van Dyke Mortgage, a name that's been on the top 1% of mortgage originators nationwide list for 13 straight years. He's a multi-time President's Club awardee. He's a creative financing architect and the guy agents call when a deal looks impossible, but it has to happen. From first-time buyers to seasoned investors, Sean doesn't just write loans, he engineers them for speed, flexibility, and success. Together, these two aren't just here to talk about home buying, they're here to give you the truth, the tactics, and the tools to win in today's market.
I don't think I usually smile this much at the
It's a good ego boost, right? Yeah. Nobody needs Red Bull after that.
Perfect. I'm glad. Let's get started, gentlemen. Sean, we're going to start with you. What's misconceptions about today's mortgage process are still keeping qualified buyers on the sidelines?
Well, I mean, lots of conversations with different real estate agents out there saying that buyers are sitting on the sidelines, waiting for interest rates to come down, waiting for prices to come down. And whether that happens or not is yet to be seen. Some buyers just had misconceptions thinking they needed to put 20% down. And, we have options where they could literally put no money down. So sometimes buyers think they need to have great credit scores. We have options, down to 640 credit scores, 580 credit scores with larger down payments, even below 580 credit scores. So I would say those are the 4 that just come to the top of my head.
Okay. And Nathaniel, how can realtors better position themselves as financial advocates by understanding what really drives loan approvals in today's banking environment?
I mean, I would begin by saying really looking at financial literacy probably is one of the most key components. I think that what, a real estate agent can do that really makes them strong in this environment is really identifying when the consumer comes to the table, making sure that consumer is understanding what are they buying, right? So if a consumer wants to go buy a home for $400,000, they still have this belief that that payment is going to be about $2,000 a month. If you take a $400,000 loan, you put 5% down, which is $20,000. In today's market, with rates currently today roughly somewhere in the mid 6s, between taxes and insurance and a full monthly payment, that payment is closer to about that for that loan on a $400,000 purchase. You're looking at a payment around $3,100 to $3,200 a month. So when you factor that, you look at kind of the average income for a consumer in the marketplace. If you take a couple of 2 in the Tampa Bay area, average annual income is somewhere around $117,000 a year. Now, that sounds like a lot, and it is a lot. But when you factor taxes and deductions, that take-home pay for that consumer, net take-home pay for a couple of 2 making gross about $117 a year is somewhere around $8,100. So if somebody wanted to buy a $400,000 home, that housing payment is $3,200 right now today. So that is very close to almost half of what their net take-home pay, not factoring utilities, right? Oh, yeah. So you have electric, you have water, you have spectrum, you have internet. So you could be close to $3,600, $3,700 a month in a housing payment. So it does create some stress. So how does a realtor leverage that? I think being more fiscally literate and when they're talking to the consumer up front in that initial buyer broker consultation, really taking the time to kind of itemize what does an actual housing payment look like on the periphery. It doesn't mean they have to get granular like myself and Sean would, but at least on the periphery, making sure that they're setting the expectations up front.
Okay.
And using a local lender, like experienced loan originator that's going to work as a team with the real estate agent as well too, is huge. Because how many times does somebody come to you and say they only want to spend $2,000 a month? They're qualified up to $4,000 a month. You know,
and that's part of the challenge. I mean, somebody could be easily qualified, and I know we were talking about this a little bit earlier. Somebody could be qualified for a $4,000, $4,500 a month payment.
Yeah.
The fact of the matter is that when they're looking at really their standard of living, they don't have the look. You don't go into a Mercedes dealership and expect to pay $150 for a brand new Mercedes out the door. You just don't walk in the dealership. I think that's conceptually where consumers have to adjust their thinking is, what does a $400,000 home mean and how do you adjust your budget? Because you can find the income, it's there. There's room to make that payment. It means maybe one less bonefish meal a meal. You know, if you go to a bonefish, couple of two, have one cocktail and a tip, it's like $100 tab, right? So maybe one or two less bonefish meals a month. Maybe you adjust your beer budget a little bit. Maybe you kind of cut some frivolous spending. But in there, myself and Sean, we can find $200 or $300, $400, in some cases $1,000 a month in frivolous spending. That if you apply that back into that home, and that conversation does happen with us, right? So to your point, not to dispel any lenders out there that are great, but if you're going out there and you're going online and you're completing a pre-approval, you're going to get a pre-approval online. But in many cases, I'm sure you've heard this, there's a lot of consumers that never had that fiscal conversation. They don't know what their closing costs are. They don't know what their housing payment is. And when you and I look at a bank statement, we can find probably $1,000 in discretionary spending that if that consumer just understands and they're educated, they'll understand that extra $1,000 in frivolous spending, if we put it into that $400,000 home, that's a difference of a new kitchen, a new bathroom. That's a difference of being in a better neighborhood or in a certain school district, and it builds equity.
So here's a question, and I asked this to Nathaniel off air, and maybe I'll ask you now. There's a renter that has been renting for 10 years, spending $3,000 in rent. They have an average credit score, say, of 680.
Okay.
And then the lender says, hey, you can't afford this $2,500 mortgage. Why is that?
Well, I mean, I don't think your average apartment complex or landlord is going to do the type of qualifications that we're going to do. They're probably going to pull their credit up, see if they have good credit scores. If they have good credit scores, they're probably writing that lease, I would imagine. I mean, if I'm, going to be a landlord, I would do my due diligence and say, how much do you make, per year for income in comparison with their credit? But I would say the average landlord probably isn't getting into the nitty gritty like we are.
Yeah, can I answer that one?
Yeah.
I mean, so I look at it from a banking perspective, right? Or just lending perspective. When you're a landlord and you're renting something on an asset that you own, if that consumer fails to make that payment, it's much easier to evict that consumer out. When you're dealing with someone that owns in Florida, when you buy a home, you own it. Even though there's a mortgage and a lien on it, you own that home. So if you fail to pay on your mortgage on time, the foreclosure process is really arduous. Excuse me. And it could take up to 3 years. With a clever attorney, someone can delay that. We know that back from the 2000. You saw that. That was my dilemma at SunTrust and AmTrust, and we had people dropping keys, and we could not foreclose on that property for 3 years just because one item in the disclosures wasn't correctly, and that consumer squatted for 3 years. By the time we got that property back, it was destroyed. Yeah. So, we had cash for keys and different techniques like that. So it really kind of comes down to a bank asset that when somebody owns a home, it's much harder to foreclose on that than when somebody's renting something. It's much easier to get them out. So you can offer some flexibility.
That's a great point. Yeah, you can evict somebody and get them out within a few months.
30 days,
60,
yeah. Correct, exactly. So
you didn't answer it that way off camera.
Well, you gave
that
me
was a much better
there.
one.
I have a client of mine that she's been in the house for 3 years now, hasn't made a payment. And it's fine. The foreclosure process, attorneys delayed things, bankruptcy situation delayed things, and it's been a few years. So that's a lot riskier for the.
It's much riskier and look, lending institutions like Sean's and ours, like Hancock Whitney Bank, we are not in the business of managing properties. We're not here to collect REOs. We're not here to manage properties. It doesn't matter if you live in a property for a long time. I mean, I remember in my days at one of my banks, I won't mention names, that, we had thousands of REOs in this area. And we didn't put them out into the marketplace. We didn't put them out there because, to your point earlier, we knew at some point in time those properties would appreciate back in value. So we wouldn't take in as much of a realized loss on our balance sheet. But when you're making those credit decisions, you have to think about the fact that we have to protect the interests of the investor, the bank, the lender, the market. So,
And we're finally starting to see bank-owned properties like on the market. Not a lot. I mean, nothing like back in the day. But a real estate agent team I know from up in Ohio, where I started my originating career, they said they had their first 2 bank-owned property listings since 2012 or 13.
yeah.
I was going to ask you guys this question. So, what we saw was a lot of overspending on houses during COVID, where people were buying it for more than what it was
Over-asking.
worth.
Yes.
Over ask. Are you seeing a lot of those loans that were approved now foreclosing? Is there a spike in foreclosure rates now in 2025 due to those loans?
I mean, I'm not personally seeing that from a lot of my past clients. However, I am seeing some like short sales come to the market where those you really didn't see, for the last 12 years. The years kind of smear together now that I've been doing it for 23. And
I mean, the over asking market kind of slowed down a lot about 24 months ago. So the over asking world, waiving inspections, waiving appraisals, all of that happened really right in the midst of the pandemic. Those consumers obtained, interest rates like we talked about earlier,
ARM
3%.
loans, right? They were using ARM loans?
No, they were using 30-year fixed rate products, but rates were very, very low. But what's transpired for those you're going back to 21, maybe 22 when you're going over asking.
Yeah.
Those properties have so much equity in them now that if a consumer did get in trouble, they could easily sell that property and get out and have substantial equity. The more challenging situation are the consumers that bought in 23, late 23, 24. There's not enough equity there. In fact, we've seen a decline in overall values. Those consumers could be either even or maybe even slightly underwater. Those are the challenges that when that consumer finally feels the pressure, and we may talk about this, about marry the property and date the rate. I mean, I could tell you a lot of us talked about assume this higher rate, eventually rates are going to refinance. It's 2 years later and rates have not come down. So those consumers are feeling the squeeze. And that's probably why we're starting to see a little more of that happening.
homeowners insurance costs go up, real estate taxes go up. Like after the first year, the buyer, if it's a primary residence, they're going to see the biggest increase the next year. Then after that, then they balance out.
Correct.
But it's has caused some issues.
So last year there was 2 hurricanes back to back. Does that affect the way a person, a lender looks at a property and says, hey, we can't lend on that specific property, especially with the Surfside condo building that collapsed?
Oh, you had to go there, huh?
Yeah, I had to. I mean, it was first time it happened in the United States, and it was right here in Florida. Do you guys? I know you're risk averse when it comes to the person that is being lent the money, but are you also risk averse when it comes to the property?
I mean, the condo guidelines have definitely tightened up a lot.
Substantially.
Where it used to be like,
Yes.
90% of the time we're getting a condo project approved up the Fannie Mae, Freddie Mac standards, conventional loans. Now it's probably 60 to 70%.
It's a problem. Condos are a challenge. I mean, they are. When you talk about the Surfside situation, what the governor kind of put in motion with regards to reserve studies, structural engineering reports. Just recently, this last House in session meeting, they've kind of loosened up just a little bit. There was some statute out there that talked about kind of extending the reserve study and what associations have to have for structural engineering reports and cures. But it doesn't change the fact that consumers are still facing surmounting assessments on their dues. That's what's making that part. Now, and you got to have it, because you're right about the Surfside component. There's got to be some structure, right? There has to be the state is responsible to make sure that these properties are sound.
Yeah.
But for properties that have been around for 30, 40, 50, 60 years, elevator shafts are old, I mean, structurally there's issues.
Yeah.
And the consumer has to pay for that owns that property. And it does put a lot of pressure on condos.
And it also prevents them from selling the property, because now whoever purchases it is now responsible for whatever fees are attributed to the rehabilitation of that structure. And they're not able to find anybody to purchase that actual property.
So for anybody listening, I just condos, we got to put it in perspective, right? Because we live in a fear-based mindset, and that's part of the challenge of what I think consumers experience now. If you get a $20,000 or $30,000 or $40,000 assessment on your condo, I see a lot of consumers panicking about that. Let's look at the reverse. If you own a home as a single-family residence detached, and that roof goes bad, That's $20,000, $30,000 right there. If your AC unit goes bad, you got to replace your condensing unit and air handler, that's $15,000. If your flooring gets bad because you had a leak in your house, that's another $5,000. So the assessment, when everyone's chipping in, it's not that bad when you think about maintenance for a single family detached home. So I think it's positioning the thought process in the right place that you're going to spend money on homes if you own it, whether it's a condo or a townhome or a single family detached residence.
Right. Wow. Well, you talked about fear, and so let's talk about a little bit fear and anxiety. So with interest rates shifting frequently, how do you help buyers manage rate anxiety and stay focused on their long-term affordability?
Valium. No. I'm teasing, but rates.
Those opinions do not reflect those of
That's
hot
right.
topics.
That's right. Yeah,
I haven't tried that yet. That might be a good idea.
Yeah, might be good. What is it? We'll ask Baker Mayfield for some smelling salts. I don't know.
Oh
But,
my goodness.
no, but so by the way, I am a Tampa Bay Buccaneers fan. So Baker,
Go
if you're
Bucs.
listening to this, I love you, man. You're awesome. We're gonna have a great year. But so it's a loaded question. I mean, to me, it's a fear-based mindset, and I think that what it comes down to is it's back to the concept of education. So what we really have to look at is in a higher rate environment, consumers have buying power. So you're trading one set of problems for another. And I think Barbara Cochran mentioned this, and there is a data point out there, and I'm sure our listeners or viewers can check this, but for every 1% drop in interest rates is a 10% increase in property values. So think about that. If it's a $400,000 home and rates are, again, just picking an arbitrary number, 6.5%. If that rate, fiscal policy, monetary policy, say 6 months, 8 months, a year from now, rates drop to 5.5%, that home you bought for $400,000 would now go to $440,000. So you might be stressed out about that rate at 6.5%, but if you do the math, you're just really robbing from Peter to pay Paul. You're trading one set of problems for another. Back to your comment about going over asking, if rates drop, because the demand feature in Tampa Bay is overwhelming. When you look at our infrastructure, we're not built for the amount of population growth that we have here, which is why we're seeing so many apartment complexes. But the demand feature for housing is overwhelming. We see a significant drop in rates from 1 to 2 percentage points. You could see a $400,000 home go from $4 to $440 to $480 very quickly. Now you're back in an over asking situation, waiving appraisals, not an inventory to go around. So I'd rather be in a little bit of a higher rate environment and have the opportunity to negotiate closing costs, negotiate temporary buy downs,
Finally.
right? To be able to do that. Finally, it's a good
Finally.
point. Now you can do that. You have the ability to negotiate, capture your equity gain on that. And then when rates do adjust, you look at the Fed dot plot, you see kind of where we're going. There's a lot of data out there to support 12 to 24 months. We should be seeing significantly lower rates. You're going to be in a better position because you'll have the equity that the people in 21 and 22 had.
I mean, I highly doubt that we'll ever get back to the 2s and 3s.
I was going to say, I mean, isn't that kind of dependent on market condition? I mean, even if they cut the rates, it's really dependent upon demand. If
Well,
people do want to still keep moving here from other
So it's
cities.
mental. When we were talking earlier, you were really excited. Can I talk about your car rate?
Yeah.
You were excited that you had a
2.99%.
2.9% car rate, right? Trust me, there are people out there that are thinking, what do car dealers do when you're looking at a football game on a commercial? 0% interest rate,
Yep.
right?
Yeah.
And people start running out the door to go buy a car. It doesn't matter that the car price went from 50 to 60,000.
Exactly.
It's 0% interest rate.
Nothing's free.
Right, exactly. So there's a mentality there, right? It's consumers. So this is a fascinating thing. I don't know if it was Steve Jobs that said this, or maybe it was Warren Buffett. Consumers are not, when you talk about opportunity, consumers are not as excited about opportunity. They won't move so much on opportunity as much as they will about the fear of loss of an opportunity.
Makes sense.
The fear of loss of an opportunity. You start to put out there in social media, publicly emphasize that rates have significantly dropped. Home sales are up again. Consumers are coming out to open houses. You will see a flood of consumers at open houses around the door because rates have dropped. It's just one mental shift, just like 0% financing and going from a $50,000 car to $60,000. So it's about really getting that consumer, and the real estate agent can do that in that buyer broker review when they're sitting down in that consultation, is share some of that data with them. There's 5 love languages, right? So I'm saying this on your show now because I'm copywriting it. You can use it, but you got to say Nathaniel said it. You can use it. But there's a sixth love language, and that's math. Math is a love language. It is irrefutable. It's factual, and if you share with consumers the math, it really diffuses them and it calms down the fear, because now the fear shifts from opportunity to loss of opportunity.
Historically speaking, rates really aren't that high right now. I mean, outside of 2008 to March of 2022, when the Federal Reserve was buying the mortgage-backed securities, rates are for the most part where they've been my whole career. From 03 to 08, rates were in like the high fives to like the low to mid sevens.
Yeah, you just
Up
showed
and
me
down.
today. It was 5.5.
Well, that was a coupon rate.
Okay.
That wasn't the at market rate. That was a wholesale rate.
Oh, okay, got you.
Okay.
So wholesale retail. So the at market, but the retail rate's different.
So since March of 2022, rates have ranged anywhere from like the low sixes up to like the mid to low seven, or so low to mid sevens for the most part.
Wow.
You know, now we're finally in the sixes again. You
So
know,
that
I mean,
means with anybody over 720, they'll get those rates 6.5 to 7.5%.
it depends on your loan amount, your loan
Right,
value,
it dep-
property
yeah,
type, it's
yeah.
investment property, primary residence, but you know, you're looking in like the 6 to 7% range now.
Yeah, I mean that's correct. And if we go back to someone will have to data check me on this one, but I want to say I think man, if I got this right, I'm pretty good. I think March of 2024. March, April, I think we saw rates at some point break 8%, go 8.25%, 8.5%. There was even so much talk about that time. A lot of propaganda out there about rates getting to 9% and 10%.
I remember that.
You remember
Yes,
that?
locked
I
it
want to
in.
say it might have been March of 2024, maybe April of 2024.
Check it, Sean. What is it?
I'm checking it. March of 2024, it was at 5.25 to 5.5. So if I check April,
That can't be right.
No, that's not right.
I mean,
Well, I don't know what
it
you're
looks
looking
like
at.
it jumped up. I don't
You
know.
might be
No.
looking at the Fed funds rate.
Yeah, you're probably looking
Okay,
at
so
their-
what should
you're
I be
at their-
looking at?
Look at mortgage rates. Mortgage rates on a 30-year fixed rate loan, March of 2024.
30-year mortgage rates.
I'm working on a refinance right now for a gentleman that closed October of 2023. He was at 8.125%.
Oh, there you go.
And now we got him like down like 1.5 points. So it's sending him like $500 a month.
Yeah.
So this is what it's saying from Realtor.com. 2024. I mean, it's showing
Yeah, it looks like it did hit.
almost
2023,
7%, because March is over here. So
Yeah, so it was a little bit
actually,
earlier.
it's up here, almost
Yeah.
to
Yeah,
8%.
There you go.
That's January 2024.
So that's the
right?
Freddie Mac rates. Yeah. So
Yeah.
so that was January. So
And that's
what
okay
if
to
we?
look at.
Yeah. So we can maybe we can
AI
look at.
news.
Can we go the whole year and see?
Uh,
Yeah. So you kind of 7.5.
There you go.
March 2024, 7.5. Now let me explain this. This is the Freddie Mac posted rate. That is not the complete retail rate out there.
So it'd be higher than 7.5.
It would be higher than
around
that.
10%.
Usually that has 1 to 2 discount points built in.
Yeah.
Correct. There's a fee to get that rate. So if you were to come to any lending institution at that time, you're probably looking closer to 8.125, like what Sean was talking about. So it's pretty close.
Which created a seller's market or a buyer's market,
That
asking
would've
for concessions.
Yeah,
Started.
yeah.
It started into like the last like year and a half-ish where it's become more of a buyer's market.
But look at the point.
Yeah.
The point is, if you look at that chart, in what is that, 14 months, 15 months, we went from 8.125 to roughly 6.5.
Thank you, Lord.
Right? Yeah. Right.
Yeah,
So
because that's a little breathing room.
we've made some significant progress.
So did you guys see a lot of loans not being written during that time period where the mortgage rates were so high? Or higher than usual?
I mean, our volume certainly went down. Our quantity of loans that we were closing certainly went down. I mean, in 2020 and 2021, I mean, I personally closed like 240 loans each of those years. But that's when rates were 2 to 3%. You know, now like I'm closing about half of that, which again, thank you, Lord. I'm still closing like close to 120 loans, which is great.
That's fantastic.
But you know, it's
Congratulations.
Not, yeah, it's not where it was because we have half of that was refi, Nance's back then. Now, you know, 90% are purchases. Last year, probably 95% were purchases. You know, but we're starting. I just locked my first limited cash out refi. The gentleman that was at 8.125%, taking them down to 6.625%. No points or anything. And if you're paying discount points, you can even get it down lower than that.
Mhm.
So
I think
Okay,
it was
we're gonna
around
take a
that
break.
time where I was trying to buy
Yeah.
another home with you,
yeah,
and I just couldn't make it happen.
Yeah.
Yeah.
you
On that
brought
note,
up a
let's take a break. We'll come back live at Fabre Framework Studio.
Yep.
We are now live back at the Fabre Framework Studio. Sean, can you break down the most creative or flexible financing solutions you're seeing working well for first-time or low-down payment buyers?
Yeah. Well, I mean, the VA loan is the best one out there for veterans, people in the military. That's 100% financing. For first-time home buyers, the Florida housing product for us is great. It's Florida bond program, HFA, Florida TBA products. There's a lot of different variations of it. Generally, they're giving up to $10,000 down payment assistance. The down payment assistance products generally will have a slightly higher interest rate, sometimes even a little bit more than slightly, compared to a regular FHA loan or a regular conventional loan. So nothing's free. Okay. A really popular one that's coming out on Monday is the Hometown Heroes program, and that's for first responders, firefighters, police officers, teacher in education, people in the military. There they'll get 5% of the loan amount, but those funds don't last forever. Like the governor signed a bill that gives $50 million of those down payment assistance funds. Last year was $100 million and it was gone in like 45 days. This year it's $50 million, but it's only for specific professions. And they have to be a Florida full-time base employee. So those are the two most popular for first-time home buyers. Our most flexible low down payment for like a move-up buyer, we have like a bridge blanket loan where somebody can get up to 80% of the value of the home they own and the home they're buying, and they can pay off whatever existing loan they have. And I've had several buyers that I've actually got money back on that product at closing. They can finance in their closing cost. It's not like your low 30-year fixed interest rates though. So, but those are the creative ones, flexible ones that I've been doing.
What about for business owners like realtors? A lot of realtors are 1099. Do they have, because the majority of people listening to this podcast are realtors.
Yeah.
What about for realtors?
Well, so it used to be called subprime back in the day when we first got into business. Now it's called non-QM products, where we can use 12 months bank statements, deposits for income, qualifying. Generally, it's using 50% of whatever those deposits were going into that business bank account. We can use 90% of a 1099. So if you're a real estate agent, you got a $200,000 1099. We can use 90% of that, $180,000 for qualifying income. If somebody's doing 20% or more down, the rates are pretty competitive on the non-QM products in comparison with conventional. So unfortunately, I'm doing like way more non-QM loans than I've done since we used to call them subprime loans back in 03 to 06 when I first got into the business. So it's great having those flexible products, but it's a lot more to learn. And a lot of the investors have slightly different guidelines for loan to values, for credit scores, property types, restrictions on what the condo guidelines. So it's just a lot more for us to know.
Nathaniel, what role do local banks like Hancock Whitney play in offering community-specific solutions that big national lenders can't?
So, banks have a significant charter. We're required to do a specific amount of residential and in some cases commercial, but mostly residential lending in underserved areas. So a bank is insured by the Federal Depository Insurance Commission, and FDIC and the federal government requires that the banking institutions that are insured have to do a certain amount of community lending. And with that, there are specific geographical targeted areas. There are many in Tampa Bay, many in St. Petersburg, scattered about, but many banks are required in this initiative to be able to offer some type of incentive for consumers in, some may call it transition areas, we call them just geographical targeted areas. It's known as Community Reinvestment Act. It's low to moderate income, LMI. And there's also an acronym known as MMCT, which is the Minority Census Tract as well too. So with that, there are grants. There's actual cash money that's available that you can help provide to a consumer. They can apply that towards closing costs. They can apply that towards a buy down of an interest rate. So that's available. As Sean had mentioned, you can parlay that and blend that in tandem with down payment assistance programs like Hometown Heroes or other great bond programs. Also, we are tapped into a lot of city, municipality, county type funding And there's quite a bit of that out there, and it can be very, very complex. So most banking institutions typically have a department, a community lending department that specializes in grants and down payment assistance as they tap into city and county municipalities. So that's a very attractive thing, an attractive offering that I think banks can offer.
On the community lending product, so we have that available as well through one of our investors. Is the area the same, whether it's at Hancock Bank, Chase Bank, Bank of America? Are those designated areas the same targeted? Like
That's a great question. It's geographically, they are all the same in terms of how much you're willing to contribute.
Okay.
Depends on the penetration. So let's get a little granular and real here for a second. So if I do a predominant amount of lending in South Tampa, and I'm dealing in a census tract that is not a predominantly minority census tract, then I am doing a lot of lending in an area that I'm neglecting a certain market share of consumer, right?
Okay.
So what happens is when you're looking at these census tracts and when we're coming out, we're being measured by that, depending on the amount of lending you're doing in certain census tract, there may be a need to do more in one specific area in relationship to another. Now there's three different components, and this is the confusing part. There's CRA, there's LMI, there's MMCT. Low to moderate income is generally the overall overarching, right? There's always low to moderate income census tracts, but then there are additional areas that the government does want specific lending to occur. So it does vary, it can change from bank to bank, and that's a really great question, because Hancock Whitney might offer something or a particular, we're giving a fabulous grant loan right now, just pure cash money in certain areas. That another institution may not.
Got it. Okay. And the difficult part, like with the city and county programs, like the income limits are lower, so it's harder for like people to qualify for those low, like at least in the Tampa Bay area.
Sure.
It's harder.
Much harder.
Like we're on the city of Tampa down payment approved list, but like, they have caps on the sales price, they have caps on your debt to income ratio. So it's just sometimes a little bit more difficult. Even though that's an awesome product, sometimes a little more difficult to get the people.
Somebody said it best to me, that they said, hey, it really doesn't matter what incentives you're giving. You can give all the cash you want to, here or there. But at the end of the day, if the consumer doesn't have sufficient funds for down payment and closing costs, they can't get into the home or affordability. So I think that answers your question.
It does. Well, gentlemen, perfect timing. Now it's the hot seat. This is where our panelists get 2 minutes to pitch their services directly to you. Nathaniel, the clock's set for 2 minutes. Give us your pitch. Tell our listeners why your approach changes the home buying game.
So for me, I really, it used to be that I used to sit at people's kitchen tables, take an application back in like 1995. So that's what you have to do, right? Nowadays, most consumers want to basically have a conversation via text or maybe through email, but they want it to be short. Look, a mortgage is a mathematical problem, and as we talked about, it can create a lot of fear and anxiety. So the key is, my approach is, I really try to make it so that when I'm talking to a consumer, I do require that we have a conversation via Zoom. We can do it after hours, on the weekends, on holidays, but typically a good Zoom conversation for 30 to 45 minutes, sometimes 60 minutes. We can really fiscally break down the numbers. We can see what's happening in the market area. We can pull up, comparable sales. We can pull up sales or properties that someone's looking at. We can see and evaluate what's happening with taxes. We can talk about interest rates. We can talk about strategies like a temporary 2-1 buy down or a temporary 3-2-1 buy down. They can create more affordability and flexibility for a consumer's payment. So my number one approach is really just having that Zoom conversation, using visual aid and imagery to kind of help create what that financial literacy plan is going to look like when a consumer goes to buy a home.
Because so many times, like, I'm on my side of the computer. They're not seeing, our side of the computer.
Someone's driving in their car and they're like, I want to qualify for a mortgage. I want to buy a home for $400,000, right? What do you think the housing payment's going to be? Well, I think it's $2,000. Well, let me go over the math. It's not $2,000. It's closer to $3,200. And now you're asking them all these questions. You're trying to explain taxes and insurance. You're trying to explain homeowners association dues. You're trying to explain CDD fees. And you're driving from Walmart to home because you just got off of work, right? Or Publix to home. And you're not capturing that information.
Yeah.
So unless you have the visual aid and the imagery, unless you could pull up a property and explain why are taxes this and what are they going to look like, what are property taxes going to look like, when you get reassessed 6, 7, 8, 9 months from now.
By the way, this isn't the norm in the industry for somebody to be doing this with a client. They're telling them, okay, here's your monthly payment. Here's your pre-approval letter. Like, we're going a step further. Like, I'm putting notes in the file. Okay, well, you're qualified up to a $600,000 purchase price, but you only want to spend $3,500 a month. You're going to need to stay closer to like a $400,000 sales price. I'll call the realtor. I'll tell the realtor, hey, by the way, they technically could go up to $500,000-$600,000, but they want their payment at a certain threshold. So try to look for homes up to $400,000, and looking like more of a consultative approach too. Like, I don't know about you, like there aren't a lot of cookie cutter loans anymore. There's a lot of hair on a lot of files.
They're more complicated.
More
I mean,
complicated.
they talked about it last year. You'll see more non-QM loans, about 30% increase, and you're seeing that. I do have a question for you, though.
Me?
Yes.
Okay, what's up?
My question is if you took because we're using 400,000 as a number, let's assume somebody finances 400,000, and the rate is 6.5%. So, and what would you think the payment would look like? So we know it's about
$3,900.
That was 3,100. About
The first year, right?
So right.
And then
so,
once it's reassessed, it would go up to $3,900 the next year.
It could go up higher.
Yeah.
Well, let's assume all things being equal, tax, right? So we'll say 31 to 3,200. If you're buying a home for 400,000, you're putting 5% down. We know it's 31. So let's just say the rate drops and it goes to 5.5%. What do you think that payment is?
I'm gonna guess around $2,800.
Okay, pretty close to that.
Yeah, I was gonna say,
That's pretty close.
That's pretty smooth.
Pretty
man.
close. Yeah. So
I went to school for engineering, by the way.
Well, that's good. So most consumers think that the rate drop from like 6.5 to 5.5 in a scenario like that, it drops the payment by like $1,000.
No.
It does not. That's why a Zoom meeting and going through and having that visual, because we're firing off. We've done this for a long time. So it's almost like an auction. Numbers to us are like, 450 this, that, 600 this, 31, 3,200 tax. For a consumer that's hearing all of these numbers, it's not accustomed to doing numbers on a regular basis. It's really overwhelming, creates high levels of anxiety, which is one of your original questions. So taking the time to have that Zoom meeting, having that consultative approach, meeting face-to-face somehow, and using visual imagery can calm them down, because I love the shock in a consumer's face when I go, well, what do you think that payment is from 6.5 to 5.5? And they give me a number, and then I show them the number, and they're like, wow, it's only a few $100.
Yeah. What if
I'm
rates
like,
don't get to 5.5? Maybe you want to look to buy now when
yeah,
you can negotiate.
it's a few $100, and I'm looking at your bank statement, and I saw that you went to Bonefish twice this month, so there's your $200. So why are you waiting to go from?
But you know what I've noticed? A lot of lenders, a lot of title companies. Well, actually, the title companies mentioned this. Lenders do not, especially when they're providing a loan. Is, hey, listen, the first year where your mortgage payment is not going to be the same as the second year, because once the house is reassessed by the county, now those property taxes go up depending on how much you paid for it. I mean, your payment can go up as much as like $400 or $500, even $1,000. I know some people, they're like, hey, my first year was only like $4,500. Now I'm paying $6,000.
So your out-of-state lenders will do that.
Yeah,
I agree with you.
Sean did let me know though. So
yeah, I mean,
Sean.
most of your like for us at Hancock Whitney Bank, we qualify a consumer, which we qualify a consumer on what the projected taxes are going to be. That can sometimes be a disadvantage. Somebody might not qualify under that circumstance. Now there's certain legislative rules out there where you can only collect so much in what's called an escrow, but we do qualify them on that. And I would say most individuals why it's so important to use a local lender, a local bank. We understand that, because what's going to happen is Sean's going to get a phone call, and I'm going to get a phone call 8 months from now, and someone's going to go, what did you guys do to me?
Yeah.
What my rate must have gone up. What'd you guys do? So if we don't have that conversation up front and show them, that's why that Zoom is so important, to go to the Hillsborough County tax appraiser's office, or Pinellas County, or Pasco, and show them in the tax estimator, this is what your taxes are going to look like. Let's adjust for that now. Let's talk about other strategies, like a 2-1 buy down or a temporary 3-2-1 buy down. So that's a very good point you're bringing up. But I found that that's the case with mostly, not everybody, but a lot of out-of-state lenders that don't understand local taxes.
Well, let's close out the hot section. This is the first time I've ever had two, I guess,
Lenders.
Lenders, competitors, like
Competitors,
work
yeah.
together.
Well, we've known
on
each
the
other.
hot
We've
seat.
known each other for a long time. So
Make sure you each right now tell the audience how they get in contact with you, which we usually.
well, let's let him do a quick commercial on
You
himself.
do
I think
your
I
quick
hope- yeah.
commercial.
Go ahead.
Well, one thing I wanted to point out, like, I had a mathematics degree in college. So like my mathematics degree isn't for complete waste. I still deal with a lot of numbers. But every lender offers FHA loans, VA loans, conventional loans. And the thing I enjoy most about my job is like just putting the deals together. Like, hey, the people say they want to do 20% down. Well, have you thought about doing 5% down and paying off your auto loan? So like to make things more affordable, because everybody wants to pay less than what their payment's going to be all the time. So I help them strategize I want to put them in a better financial situation like after they met me than they were before they met me. That's my goal. I mean, most of us lenders, again, offer the same products. Everybody closes fast for the most part. So I work at Van Dyke Mortgage. I love it there. I've been there for 15 years. It's a local lender. We're in 48 states. I can call my underwriters, call my processors, same as you. Call my servicing department, call my secondary department. Like, hey, by the way, somebody's talking with another bank and like their interest rate's a little bit lower than ours. Like our secondary department will work with us. My company's been in business for 40 years. I've been in business for 23 years. I mean, I've closed thousands and thousands of loans, and I still say, wow, that's the first time that's come up before, more often than I would like. But experience. Like if I'm a realtor, there's no way I want to have my buyer going to some online sweatshop lender that you're keeping your fingers crossed their earnest money's not in jeopardy. And
I'm going to give you a plug real quick because I feel like I have to, because I've known Sean for a long time. So he's correct. We talked about this earlier. We all kind of tap from the same well. But here's the thing. When you look at a team of underwriters, processors, closers, funders, it's like a symphony, right? So a cellist is a cellist, a pianist is a pianist, right? A drummer is a drummer, a flutist is a flutist, right? But here's the thing, you gotta have a great conductor. Someone's gotta keep the timing, the rhythm, or else the symphony doesn't perform well. This gentleman is an excellent conductor. So you've done a great job in this market. You have a great reputation, and bravo to you, my friend.
And I can give AI doesn't take over all that.
Well, that's another podcast.
Well,
for another day.
and I can give him an actual customer testimonial because he was my lender on my first home. So 5 stars. Absolutely call Sean Miller. And also Nathaniel Bittman.
Let's not forget
contact
Nathaniel
info?
a little bit. I mean, there's a few things we can do well too, like construction, lot loans, things like that. So we have some good product out there.
Perfect. Close
Dr.
out my
Loans.
hot seat. How does people contact you guys?
They can reach me. You can call my office, 727-214-6400, or cell phone, 813-383-6066, or Sean Miller, home loans at vandykemortgage.com.
Yeah, just reach out anytime. Please call. Let's have a conversation. So my phone number is 813-382-2653. That's 813-382-2653. Call, text, doesn't matter. It could be after hours, could be on the weekend. My dad told me something when I got in the mortgage business back in 1995. When I looked at him and he said, "You're getting in the mortgage business?" And he goes, "Let me tell you something. Money never sleeps."
True.
Money never sleeps. So remember, you got to be available on call like a doctor all the time. So here for you whenever you want to have, even if it's just a conversation about numbers, let's just talk numbers.
Perfect. So, gentlemen, tell me, what's one overlooked financing tool or program that could be a game changer for buyers in our local market?
For me, the big game changer now, sort of like kind of the crescendo, is going to be the 2-1 the 3-2-1 or the 2-1 temporary buy down. I think that you get a lot of bang for your buck on that. Sellers are very flexible right now. They're willing to negotiate. So I often encourage that, you look at something like a temporary 3-2-1 buy down, because it does give you payment flexibility that your first year, your payment could be, depending on the loan size, right? So depending on how much you're financing, but your first year's payment could be anywhere from $200 to $500 less a month in year 1. If you haven't refinanced by the end of year 2, you may be about $200 to $300 less of what your maturity payment is. And by the time you got to the end of your second year into your third year, if you've not refinanced at that point in time, you do assume your normal maturity rate. But I I think that's a great strategic tool that most consumers can use because, again, once consumers can get over the shock factor of the payment, you get them in a more comfortable, flexible place. They can adapt. They have time to budget for any kind of changes, and they have time to kind of adapt to that change.
Well, the awesome part about doing the 2-1 buy down, if they refinance before at the first year mark, they get back the credit of whatever wasn't used
That's
up
right.
of that 2-1 buy
That's
down.
right.
I actually didn't know that until like about a year and a half ago that
Yeah.
we got that back.
Yeah.
That's awesome.
It is the only misconception about whichever temporary 2-1 buy down is the seller is basically prepaying your interest for 2 years. So if your rate was 6.5%, you're at 6.5%, but year one, the seller prepaid your rate down to 4.5%. So they kind of basically prepaid the interest on your payment. So Sean is correct. If you get to the end of year one, you refinance, there may be several thousands of dollars that have not been used that they've prepaid on your behalf. You have the ability to apply that to a principal reduction, which a few $1,000s like that could be applied towards your refinance because you have the principal to be able to do that now.
And I'd say the one that I utilize a lot, so for your people that are going to be selling after they buy, so they do a conventional loan, they put 5% down, 10% down, 20% down before they sell their house, and their monthly payments based off of, let's just say they did 20% down at a $500,000 sales price. Their loan amount's $400,000. Okay. Fast forward, sell their house. After they make 6 mortgage payments, they can do a principal reduction payment, and they can recalculate the principal and interest portion of the loan without having to refinance. Oh. That's a conventional, and they do have to make 6 payments first, though. And then on the 7th payment, they can do the principal reduction. They need to contact their servicer before they do all this, but that gives them a lower monthly payment then for those years going forward. Yeah. So they do have a higher monthly payment for 6 months. Now that's conventional loans only that they can do that. For any like VA, FHA, they got to refinance to get that one.
To be able to do that.
Gentlemen, if today's housing market were a dating app profile,
I wrote down a couple of things.
What would it say? And would buyers be swiping right or left?
I mean, if you're ready, I wrote this one down too because it took me some time to canvas this one, so I have to find that language. But all right, you want to go or you want me to go? You can go.
Loves expensive taste because they usually want to, the buyers usually want to buy the home that their parents live in now versus the home that their parents bought as their first house. So buyers have very expensive tastes. Okay. Like you don't need the house that your parents ended up in. Look at a little less expensive house, okay. And our sales manager in my office, John Jones, I got to give him props for this. He said, he goes, people are looking for their third wife before they get married once. That one was hilarious. Give me props to you, JJ.
Are you swiping right or left? Are you swiping right or left?
Oh, I guess I had to go right. So.
Okay. Go right with that one. Daniel, you're up.
So this is I thought this is fabulous. So in today's housing market, if today's housing market were a dating profile, Tampa Bay's would read stable, financially improving, and ready for commitment. CPI is cooling, builder sentiment is up, and consumer confidence has returned to above 70. Buyers swiping right are locking in homes before potential appreciation accelerates. Those swiping left may find themselves priced out if rates drop and competition surges.
Wow, that was good. That was really good.
It's true. True.
It's pretty clever, right?
That was.
It's fun. Great question, though.
Yeah, don't sit on the fence for too long. It is impossible to time out the market. You can't time out stocks. You can't time out Bitcoin. You can't time out the housing market. You're not buying a house to stay in for 2 months or 3 months. This is a home that you're typically going to live in for 5 years, 10 years.
Yeah, just overall, in conclusion, my only thoughts are just, do a budget. First of all, know the numbers, right? But outside of that, do a budget, pull your bank statement, find where are some of the discretionary spendings at, put that off to the side. We all have it. Every one of us look at the banks and we're like, wow, did I really spend that? I went into 7-Eleven. It looks like I kind of grocery shopped. I went in for fuel, but I spent $110. So, you can identify that. Some people have done that.
Real quick pro tip, you could input that into ChatGPT and it will tell you where all your discretionary spending is.
I don't know if I want to know that.
That is a good pro tip because I'll tell you, I've seen consumers, I'm like, did you go to 7-Eleven? How'd you spend $110? They don't even know. They have no idea what it was. And I'll hear the spouse on the the other line say, oh yeah, you bought beer and some chips, and you got this and that, and you also got a Slurpee, and the kids got this and that, and right. So know your budget, and that's really probably one of the most important things. So
good. Well, this is the kind of fire that turns maybe someday into close today. Nathaniel, Sean, you've just given our listeners an inside track to winning in today's home buying game.
And can you tell us where we can find one of those jackets at? So we can
I've had this since 2023, so I can't tell you yet. But don't forget to follow, subscribe, and share. And as always, this is your host signing off. Until next time, keep pushing boundaries, delivering value, and standing out like the star you are.